Many people believe you need a lot of money to start investing, but is that really true? The reality might surprise you. Even with a small amount, it's possible to begin building wealth if you understand the right approach. The problem is, most beginners either wait too long or follow the wrong strategies. In this video, we're exploring the truth about investing with little money, breaking down what actually works, what doesn't, and how you can start growing your money no matter where you begin. Today, we will talk about the truth about investing with little money. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. You don't need a lot of money to start. One of the biggest myths about investing is that you need a large amount of money to begin. In the past, investing often required significant capital, but today, things are different. Many platforms allow you to start with very small amounts. Even a few dollars can be enough to begin your journey. The important thing is not the size of your first investment, but the habit you build. Starting small helps you learn, gain experience, and understand how investing works without taking big risks. When you begin with what you have, you remove the biggest barrier, waiting. And once you start, it becomes easier to continue. 9. Consistency matters more than amount. Investing is not about putting a large amount once. It's about putting smaller amounts regularly. For example, investing $50 every month may not seem like much, but over time, it adds up. Consistency allows your investments to grow steadily. Many people wait until they have a large amount to invest, but this delay costs them time. Regular investing builds discipline and creates momentum. The habit of investing consistently is more powerful than occasional large investments. It keeps you connected to your financial goals and ensures steady progress. 8. Time is your biggest advantage. When you invest with little money, time becomes your strongest asset. The earlier you start, the more time your money has to grow. This growth happens through compounding, where your earnings generate additional earnings over time. Even small amounts can grow significantly if given enough time. Starting early allows you to benefit from this effect, while waiting reduces your potential growth. Time works in your favor when you invest consistently. The longer you stay invested, the stronger the results. 7. Small investments still teach big lessons. Starting with a small amount is not a disadvantage, it's an opportunity to learn. When you invest small amounts, you can understand how markets work, how prices change, and how your emotions react to gains and losses. These lessons are important. They help you build confidence and avoid mistakes when you invest larger amounts in the future. Learning with small investments reduces risk while increasing your knowledge. This experience becomes valuable over time. 6. You must control your expectations. One of the biggest mistakes beginners make is expecting fast results. When you invest small amounts, returns will also be small in the beginning. This is normal. Investing is not a quick way to get rich. It's a long-term process. Unrealistic expectations lead to disappointment and can cause people to quit early. Instead, focus on steady growth and long-term results. Understanding this truth helps you stay patient and committed, which is essential for success in investing. 5. Fees and costs matter more. When investing small amounts, fees can have a bigger impact. High fees can reduce your returns significantly, especially when your investment is small. That's why it's important to choose low-cost options and avoid unnecessary charges. Even small differences in fees can affect your overall growth over time. Paying attention to costs ensures that more of your money stays invested and continues to grow. Managing fees is a simple but powerful way to improve your results. 4. Diversification is still important. Even with little money, it's important not to put everything in one place. Diversification means spreading your investments across different assets to reduce risk. This protects you from losing everything if one investment performs poorly. Many modern platforms allow you to invest in diversified options even with small amounts. This makes it easier to manage risk and build a balanced portfolio. Diversification helps create stability and improves your chances of long-term success. 3. Avoid emotional decisions. Investing is not just about money, it's also about behavior. When prices go up, people feel excited. When prices go down, they feel scared. These emotions can lead to poor decisions, like buying at the wrong time or selling too early. With small investments, emotions may feel less intense, which is actually an advantage. It allows you to practice staying calm and making rational decisions. Controlling emotions is one of the most important skills in investing. It protects your progress and keeps you focused on long-term goals. 2. Increase your investment over time. Starting small is good, but growing your investment over time is even better. As your income increases or your expenses decrease, try to invest more. Gradually increasing your contributions accelerates your growth. This step is important because it turns small beginnings into meaningful results. Over time, your investments become larger and the impact of compounding becomes stronger. Growth comes from both consistency and increasing your efforts when possible. 1. The habit matters more than the amount. The most important truth is that investing is a habit. It's not about how much you invest at the beginning. It's about building a consistent routine. Once investing becomes a habit, it becomes easier to continue and improve. This habit shapes your financial future. It builds discipline, creates long-term growth, and changes how you think about money. People who develop this habit early are more likely to achieve financial stability and independence. This is the truth most people ignore, but it's the one that makes the biggest difference. How it all works together. These truths are connected. Starting small removes fear. Consistency builds progress. Time allows growth. Learning improves decisions. Managing costs protects returns. Diversification reduces risk. Emotional control keeps you stable. Increasing contributions accelerates growth. And the habit keeps everything moving forward. When combined, these principles create a strong foundation for investing, even with limited money. Real-life perspective. Imagine two people with limited income. One decides not to invest because they think the amount is too small. Years pass, and they have no growth. The other starts with a small amount, invests consistently, learns over time, and increases their contributions. After a few years, their investments grow, and they gain financial confidence. The difference is not income, it's action and consistency. Investing with little money is not a limitation, it's a starting point. What matters is taking the first step, staying consistent, and thinking long-term. Even small amounts can grow into something meaningful when given time and discipline. Don't wait for the perfect moment or a large amount. Start with what you have and build from there. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.